The market fell last Friday because the economy was too strong. If you think that sounds backwards, you're not alone. So today we're going to break down what happened, why investors reacted the way that they did, and what it may be telling us about where we are in the economic cycle. I'm Christiana Lovelace. I'm a licensed financial advisor, an accredited asset management specialist, and the owner of Diamond Point Financial. Each week on Pointe Perspective, we help you make sense of the markets, the economy, and your financial life from a professional perspective, so you can make financial decisions with more clarity and confidence. This week, we're focusing on perspective and preparation. First, we'll discuss the market decline that followed the May jobs report, why strong economic data can sometimes create negative market reactions, and what that may tell us about the current environment. Then we'll continue our discussion around estate planning by focusing on steps you can take today before ever signing a legal document, helping create clarity and organization for the people you care about most. And finally, we'll have a quick tax planning update to help you prepare for the second half of the year. Because whether we're talking about markets, the economy, or your family's future, good decisions start with understanding what's actually happening beneath the surface. On June 5th, the market experienced a sharp decline immediately following the release of the May jobs report. At first glance, that may seem strange. After all, the report showed that the economy added 172,000 jobs, roughly double what economists were expecting, while employment remained at 4.3%. So why would markets fall on good news? It's because, like so many other topics we've discussed, markets don't react to the information itself. They react to what that information may mean next. The primary concern was interest rates. For months, investors have been hoping that the Federal Reserve would eventually begin lowering rates and sparking growth. But a labor market that remains this strong creates a different problem. If employers are still hiring aggressively and unemployment remains low, the Fed has less reason to provide economic stimulus through lower rates. In fact, some investors began discussing the possibility that rates could potentially move higher if inflation persists and employment data stays strong. Higher rates tend to create pressure on smaller companies, highly leveraged companies, speculative investments, and growth-oriented sectors that depend heavily on future earnings. And that's exactly where a lot of the selling occurred. One thing that's worth understanding is why investors become so sensitive to interest rates in the first place. Higher interest rates don't just affect mortgages and credit cards. They affect how businesses operate. When rates rise, borrowing becomes more expensive. Expansion projects, acquisitions, and large amounts of debt on a balance sheet all become more expensive. This is especially important for growth-oriented companies. Many growth companies are valued based on what investors believe they may earn years from now. When interest rates rise, investors often place a lower value on those future earnings. That's one reason why markets pay such close attention to interest rate expectations. It's not about the rates themselves, but more about how those rates affect the future value of businesses. The second piece of this puzzle is something investors often overlook. Markets don't operate in a vacuum. When major investment opportunities become available, capital has to be free to invest in them. With the anticipated SpaceX IPO approaching, there has been discussion about investors preparing liquidity for potential participation. At the same time, after a strong market run and repeated new highs, some investors were already looking for an excuse to take the profits and rebalance positions, or as I call it, they're cashing in on their wins. Reports also noted concerns about a wave of large equity offerings competing for more investor capital. So strong jobs data simply became the catalyst. The market decline wasn't necessarily a statement that the economy suddenly became weak. It was a repricing of expectations. This is where I think it's important to separate economic data from personal experience. When you spend time online, especially with social media algorithms, it's easy to walk away with the impression that the economy is collapsing. And to be fair, many families are dealing with very real challenges. Higher prices, housing affordability, insurance costs, and rising living expenses. Those frustrations are all legitimate. A healthy economy doesn't necessarily feel healthy to everyone, and that's where a lot of the confusion comes from. Economic data measures broad trends. It looks at employment, production, spending, lending, and business activity across hundreds of millions of people. But individual families experience the economy through their own circumstances. Someone trying to buy their first home may feel tremendous pressure. Someone who recently lost a job or who is carrying high amounts of expensive debt may feel like the economy is doing terribly. Those experiences are real, but they don't always reflect what's happening across the entire economy. This is one of the reasons economists focus so heavily on data. It's not that your feelings don't matter, because they do, but feelings are personal, where data helps us understand the broader trends. And sometimes those two things can tell very different stories at the same time. If the economy were truly falling apart, investors wouldn't be worried about a rate hike. They'd be demanding rate cuts. The fact that markets sold off because employment was too strong is actually telling us something important about where we are in the cycle. We've talked about economic cycles before. Every cycle creates its own narrative. During expansions, people convince themselves that growth will never end. During slowdowns, people convince themselves that everything is broken. Both can become forms of confirmation bias. The data today suggests an economy that is slowing from the extraordinary pace that we saw after the pandemic, but remains fundamentally resilient. Job growth remains positive, unemployment remains low, businesses continue hiring, and consumers continue spending, although more selectively. That's not a perfect economy, but it's also not the economic collapse that headlines continue to suggest. One of the biggest mistakes investors make is allowing headlines to replace analysis. Markets, economies, and business cycles are complex systems. It's important to look beyond a single headline or a single report or even a single month of data before drawing larger conclusions. At the end of the day, markets react to expectations. And on June 5th, investors weren't responding to bad economic news. They were responding to economic data that was stronger than expected. Those are two very different conversations. As we continue our June discussion around estate planning, I want to focus on something that often gets overlooked. Last week, I asked you to begin thinking about the people you want to include in your legacy and to make a list of your assets. This week, I want to show you that there are several meaningful steps you can take before ever sitting down to sign a legal document. Estate planning is more about organization and communication than it is just paperwork. The more organized you are before the legal process begins, the smoother everything tends to be. One of the first places I would start is with a beneficiary review. Review your retirement accounts, investment accounts, life insurance policies, and any other accounts that allow for beneficiary designations. Sometimes there are different terms used depending on the account. So for instance, an investment account may have it listed as a TOD or transfer on death. Or you may see accounts that say POD, payable on death. Essentially, all of these communicate the same thing. When you pass, you want this to go to that person. Unfortunately, I've seen situations where designations hadn't been updated for years. Former spouses, former partners, or outdated family members were still listed because no one thought to review them after a major life event. And in many cases, beneficiary designations can override what is written elsewhere. The next step is to have a conversation with the people you've selected. Talk with your beneficiaries about your wishes. Speak with the person you've chosen to serve as executor, power of attorney, or healthcare decision maker. Make sure that they understand the responsibility and are comfortable accepting that role. You may be surprised how often people assign these responsibilities without ever having the conversation. Here at Diamond Point, we offer and encourage our clients to hold these meetings at our office. Sometimes having a mediator facilitate the discussion can take the pressure off of these tough conversations. I would also encourage you to begin documenting your wishes. This can include healthcare preferences, end-of-life decisions, funeral arrangements, and other personal requests that you want your family to know about. Even if those instructions are not yet legally formalized, writing them down can provide valuable guidance. And when it comes to funeral planning, many providers will allow you to document your preferences in advance. Some families choose to prepay for those expenses, while others just simply document their wishes and keep everything organized for later. Either approach can reduce uncertainty for your loved ones. Another tool I strongly recommend is creating what I call an If I Die binder. This is simply a central place where important information is organized and easy to locate. It can include account information, insurance policies, property records, contact information, beneficiary information, copies of important documents, and perhaps most importantly in today's world, digital access. One of the most overlooked challenges families face today is simply gaining access to information. Many of our lives now exist behind passwords, authentication apps, online portals, and cloud storage. I've seen situations where surviving family members spent months trying to gain access to important records because nobody knew where anything was. In some cases, people have even hired specialists to recover information that should have been readily available. A little organization today can prevent a tremendous amount of stress later. As we move through this month, we're going to continue building on these concepts. Next week, we'll discuss some of the planning tools that typically require legal documentation and professionals. That includes wills, trusts, powers of attorney, and other strategies that help formalize your wishes. At Diamond Point Financial, we help clients coordinate these conversations and access estate planning resources as part of their financial plan. Because the goal isn't simply to create documents. That is the easy part. The goal is to create clarity, organization, and a smoother path for the people you care about most. Before we finish, I want to leave you with a quick planning reminder. We're now 6 months into the year, which makes this an excellent time to start reviewing your tax situation. One of the biggest mistakes I see people make is waiting until November or December to start thinking about taxes. But by then, some opportunities may still be available, but your flexibility and control are often reduced. This is a great time to review your income, estimate your effective tax rate, and compare that against what you've already paid or what you expect to pay throughout the year. It's also a good opportunity to review your retirement contributions. Make sure you're on track for any contribution goals you've established, and if possible, verify that you're maximizing available retirement accounts. Small adjustments made in June can be much easier than trying to make a large correction later. The sooner you identify an issue, the more time and flexibility you have to address it strategically. Today we discussed why the market reacted negatively to positive economic data, why facts and feelings don't always tell the same story, and how a little organization today can make a significant difference tomorrow. If this helped bring some clarity to what you're seeing in the markets, in the economy, or in your own financial life, make sure you subscribe to our channel for new discussions every Thursday. If you prefer a more concise breakdown, you can subscribe to our weekly newsletter every Friday. If you have questions about your own financial situation, you can learn more about Diamond Point Financial using the information below. I hope this offered some useful perspective, so until next week, take care.